Hello, I'm Haider Malik, host of the MEMI Financial Group podcast. Today's topic is lease versus loan, choosing the best equipment financing option. Deciding between borrowing to buy and leasing to use can shape your cash flow, balance sheet, tax position, and long term cost. Let's look at key factors so you can match your financing to your business needs. When you take a loan, you borrow money to purchase the equipment. You typically put down 10 to 20%, then repay principal and interest over a set term, often 3 to 7 years. You own the asset from day one, can claim full depreciation, and build equity. Loan rates are usually lower than lease rates, but you'll need collateral, often the equipment itself, and may tie up working capital in the down payment. A finance lease or capital lease behaves much like a loan. You enter into fixed payments over the equipment's useful life, and at term end, you can buy the asset for a nominal fee. It sits on your balance sheet as both an asset and liability, and you receive depreciation tax benefits. Because the lessor retains legal title until purchase, you preserve cash upfront but still capture most ownership advantages. An operating lease works like a rental. You pay a monthly fee to use the equipment, typically 36 to 60 months, and return it at term end unless you negotiate a purchase option. The lessor bears residual value risk, and leases often include maintenance, reducing downtime, and surprise repair bills. Lease payments are higher per dollar financed, but you conserve cash and avoid obsolescence. You simply upgrade to a new model when the lease expires. To choose the best path, start with your cash flow priorities. If you need to preserve capital, perhaps for rapid growth, seasonal swings, or other investments, an operating lease minimizes initial outlay and bundle service. If you have ample cash or equity and want the lowest long-term cost, a loan or finance lease with minimal fees is usually optimal. Next, consider how long you'll keep the asset. For long-lived machinery, like CNC equipment or heavy trucks you expect to use for 10 years, a loan locks in lower rates and lets you capture full resale value later. For assets that depreciate quickly or face rapid technology advances, IT hardware, medical devices, or specialized diagnostic tools, an operating lease delivers flexibility. No need to manage resale or end-of-life disposal. Tax and accounting treatment matter. Under most rules, loans and finance leases allow you to capitalize the asset and claim depreciation, while operating leases may be treated off-balance sheet or as service expenses, improving key ratios like debt to equity and EBITDA. Check with your accountant. Lease payments may be fully deductible as operating expenses, while loan payments include interest and principal components with different tax impacts. Maintenance and support can tilt the balance. If equipment uptime is critical, say for cold chain refrigeration units or CNC spindles, an operating lease that includes preventive maintenance and parts coverage can save you from unpredictable repair costs. Loans leave maintenance entirely on you, so factor in service contract fees when comparing total cost of ownership. Let's illustrate with a $200,000 excavator over 5 years. A 6% loan with 20% down requires monthly payments of about $2,900. You own the machine and after 5 years could sell it, recapturing residual value. An operating lease might run $3,500 per month with no down payment and include full maintenance. You never own the asset, but you avoid a $40,000 down payment and end-of-term resale headaches. Total lease cost is higher, $36,000 more, but you gain flexibility and bundle service. In summary, loans deliver lower overall financing cost and full ownership, ideal for long-use assets and when you can afford down payments. Operating leases offer predictable expense, minimal upfront cash, and service bundles, great for short life cycle or rapidly evolving equipment. Finance leases combine elements of both, letting you spread payments with eventual purchase and depreciation benefits. Evaluate each scenario by modeling cash flows, tax savings, end-of-term options, and maintenance needs. By aligning your financing choice with your cash flow profile, asset lifespan, tax strategy, and service requirements, you'll select the structure that supports growth, controls cost, and keeps your operations running smoothly. I'm Haider Malik. Thanks for listening.